Okay, I'll just check that you guys can hear all right. How's sound over here? It's good? Okay. What about you guys at the back? You okay for sound? You want a bit more? How's that? Is that better? It's okay? Okay, and you guys okay for sound here? No? And the guys in the middle? You're fine. Good. Right. Okay. Okay, so we'll make a start. We'll just have a brief review of what we did last time, and then we'll progress on. So we're in the topic of basically looking at the term structure of interest rates and at the yield curves. And when you build a yield curve, what you try to get is bonds that are as similar as possible, but only differ in time to maturity, because what you're trying to do is construct a curve which basically relates time to maturity to an interest rate. Now, in practice, it's often very, very difficult to get bonds that are identical, and so what we tend to use in practice is we tend to use the most recently issued government bonds of any particular maturity length. So that's where we tend to get the data from to construct a yield curve from the government bond data. Now, we looked at several types. There are three common types. There's the ascending yield curve. That's where basically as time to maturity goes up, the interest rate goes up. There is the descending, which is the opposite. Basically, as time to maturity goes up, the interest rate goes down. And then there's the flat one, whereas basically they are same interest rate across all maturities. And in terms of actually finding them, the most common one is the ascending yield curve, but the other ones are seen at other times. They are often interpreted in terms of what the economy is doing. And if you see an ascending yield curve, often that's interpreted to mean that the economy has potential to grow faster and probably will pick up speed in the months and years ahead. The descending one is often seen at the point where the economy is actually growing faster than it can sustain. So it's actually growing at an unsustainably high rate. And when you see a descending yield curve, that tends to indicate to you that in the future, economic growth may slow down, may even head into a recession. And the flat one, where things are pretty much constant interest rate across all maturities, that's interpreted as usually as being in a transition period. So we look into the past and see what's happened. So if you're coming out of a period of high growth and it's flat, that means you're transitioning into a period of low growth. If you look into the past and you see that you've been in a period of low growth and you've got a flat yield curve, that tends to mean that the economy is coming out of that slow period and moving into a period of faster growth. So that's how they're often interpreted when you see them. We then went on to discuss the first of the theories of the yield curves, because there are several theories, and the one that we actually talked about was what's called the expectation theory. And the basic idea behind this is if you have two or more paths to an investment destination in the future, what we would like is for all those paths to have exactly the same value. So it doesn't matter whether the example we looked at, if you had a 2-year security and a 1-year, it doesn't matter whether you buy the one, roll it over to another one, or buy the two. If you're going to go out 2 years in the future, you end up with the same value at the end of the time. And using that idea, we can then use either observed rates to calculate what we call an implied forward rate. That's one that we cannot see, but we can calculate. Or we can do it the other way around. We can actually forecast interest rates, and then we can calculate what the long-term rate should be. And so in all cases, whether we're actually working from existing interest rates and calculating a forward rate, or we're making forecasts and putting those in to our formulas to generate an interest rate for today, we use the geometric averaging across time. So we don't use arithmetic averaging, even though when you look at them, the results come out very similar. So we got to the point we got this question here. So this was just going to be a numerical example of it. So the data is, we've got this current 1-year rate. So this is the rate that we can actually see, 6%, and the market expects 1-year rate a year from now to be 8%, and then the 1-year rate 2 years from now to be 10%. And so what we want to find, in this case we want to calculate what should be the current 3-year interest rate. And usually if you do this, you would calculate it and you compare your estimate with the actual market. So how would we go about actually calculating on the basis of that data, what a 3-year interest rate should be. Ooh, all very quiet. Right, well, let's think about this, how we might do it. So if you think about what we have here, let's put a timeline. So this is time long here, 1 year, 2 year, and 3 year. And that's where we are today. So what we actually have is that we actually have a market rate there, and that's the 0R1 rate. So that means it applies now, and it goes for one period. In this case, the period that we're using is a 1 year. What we want is to calculate what should be the current 3-year interest rate. So what we're going to try to get is one that runs across here, and that will be what we call a 0R3, and that 0 indicates it applies today, and it runs for 3 periods. In this case, the period is a year. Now, what we don't have in terms of actual numbers is that we don't have market rates for the intervening ones. But what we have instead from our data here is that we have made forecasts. Now, however we make those forecasts, we've got them. And so there's an interest rate that applies in this period here, which we call a 1F1 rate. That's a rate that starts 1 year in the future, and it runs for 1 period. And we have that up there. And then there's another one here, starts at this point here, and this is a 2F1. So this starts at time 2, runs for 1 period, and so it ends up at time 3. So what we would like is the two paths to have equal value. So whether you bought a single 3-year investment today, or you bought a 1-year investment and then rolled it over twice, we want this then to have the same value. So what we need is that this 1 plus this interest rate here, this is the 3-year one, cubed. Now this is assuming that we're going to have annual compounding. If we're going to have some other period of compounding, we have to modify this slightly, but we'll assume that we're just dealing with annual compounding. So the first one we actually know, because we can go out into the market and see that. That's the 0R1 rate. And then we've got our two forecasts. So these are ones that we have actually forecast, however it is that we did that. There's our rate that applies for the 1 year, and then we multiply it by that rate for that final year there. So it starts at time 2, runs for a year, and ends up. So what is the 0R1 rate from this data here? What's the 1-year rate now? 6%. So we can shove that in there, 1.06. And what's the 1F1 rate? 8%. So that's the one that applies for a year from now for a year. So that one is 1.08. And what about this one here, the 2F1? 10%. So that's 1.1. Now, if you multiply all that together, that comes out at about 1.25928. And so that's cubed. So if we want to solve for this rate here, 0R3 rate, that's 1.2598 to the 1/3 power minus 1. And that's approximately 7.99%. So it's not very different from the arithmetic average, but it is a little bit, just in this case, about 1/100% down on the arithmetic average. Okay, any questions on how we did that? Okay, everybody all very happy? Good. Right. So basically that stuff there is what I just did. And this key point here, do not use an arithmetic average. Use this thing here, which is your geometric averaging, because arithmetic averaging is only useful in case that we are using simple interest, and almost everything that we do will actually be involving compound interest, and when you deal with compound interest, you need to use the geometric averages. Okay, So I've got a formula here. Let's work out what, because we've got a problem coming up. We're going to work out what on earth this thing means. So give it another bit of paper here. So this is the basic problem that we're going to deal with. So we've got this formula here. This is the implied one-year forward rate at some time in the future. So if we draw up another diagram of what on earth we're talking about here, is here's time along here, and we're going to just have, we want to find this interest rate out in this period here. That's what we want to find. So in terms of what we have, what we'll do is we'll make this a 0 so it applies today. Make that one applies today, and we'll get rid of that one there. Make it nice and easy. So those are zeros. So this one here, is that something we have to calculate, or is that something we can go look up? The top one, the 0RN. Is that something we can go and look up in a market, or do we have to calculate that somehow? Observable. You can see it in the market. So to plug that in the formula, it's quite simple to go out into the market and actually see that. So that one, which applies from here to here, to the 0RN rate, is something you can go out into the market and you can see it today and simply look it up. What about the one on the bottom, the 0RN minus 1? Do we need to calculate that, or can we see it? You can see it. So that's one that you can actually see in the market. So that's a 0RN minus 1 rate. And the thing that we want to calculate, which is on the other side there, is this rate in here. And this is the N minus 1 F1. So it starts at time N minus 1, runs for one period, so ends up there. So if you think about what we want to happen, is we want this path here, okay, this is 0RN to the power N, we've got N compounding periods, to be exactly equal to 1 plus 0RN minus 1 to the N minus 1 power, so that takes care of that bit there, multiplied by the 1 plus the N minus 1 F1 rate, which is the one we're trying to find. So solving for this rate, this is the one we want to find here. The N minus 1 F1 rate is going to be this one, 1 plus 0RN to the power N divided by this one here, 1 plus 0RN minus 1 to the N minus 1 power, subtract off the 1. So when you're doing these calculations, if you're a little bit stuck about what you should do, not quite sure what you should do, often drawing some sort of time diagram like that, once you've got that written down, you can often see what you should do. So if you look at the data and think, I don't know what to do, it's not really obvious. If you draw up basically some time, put in whatever you need, in this case we have interest rates, you can often work out what you're supposed to do once you have some sort of diagram like that. So we're going to apply it soon to a problem. Any questions on this before we go and actually try to use it? Okay. So we'll move to this problem here. So grab another bit of paper. If we draw up what we have, so 1, 2, and 3, we have this rate here, the 0R1 rate. We have a 0R2 rate, and we have a 0R3 rate. So that's what we have. They're given there. Okay. So if we're going to calculate what we want to say here is we want to apply a 1-year implied forward rate for year 3. We've actually got 3 lots of data there from 1 year, 2 year, 3 year, but we're not going to actually use them all. Which is the one you're not going to use? Which one are you going to leave out? The 1-year rate. Okay. So even though you have a 1-year rate, when you do this calculation, it's not going to be any use to you because what you want is this rate out here. And this is a 2F1. And so when you think that this applies for year 3, and you want a 1-year rate, you want this bit in here. Okay, and so you can see, having drawn that up, that you can use the 2-year rate and the 3-year rate. This one here, even though you have it, is not of any help to you. So put it in. There's 1 plus 0R3 cubed. That's that one there. And that's going to equal 1 plus 0R2 squared times 1 plus the 2F1. And that's not to any power, because that's simply a 1 period. So we can solve for this one, and we essentially end up with the equation we had before. Oops, hang on. Let's put the black ones. Okay. 0, 1, 0R3 cubed, and then 1 plus 0R2 squared minus 1. So what's the appropriate 3-year interest rate? We need this one here. To do the calculation, we need that one there.
Oh, so 2.71%.
Yeah, because we got it there at 2.71%. So that's 1.0271 cubed divided by, what's the appropriate rate for the 2-year rate? Yep, the 2.39% that's given to us there. And you square that, and you subtract off that 1. Now, if you do that calculation, what you come up with is that the implied rate, a year from now, sorry, 2 years from now, is about 3.35%. So, by drawing up that diagram, you can pretty much see what calculation you have to do. And even though in this case you have more data than you need, when you look there, you do actually have what you need. And you simply go and plug it into the formula, and you can come out with an estimate of what. And what we're essentially doing is saying the market consensus is that in 2 years' time, the 1-year rate will be 3.35%. So we've taken the information we've had in the market today and worked out what is implied by that for the future. Okay. Any questions on that? People are all happy. Right. So here's a bit of longer-term one. This one is goes for 5 years. But again, it's relatively straightforward to do. As soon as if you don't see what to do, again, you can draw up a timeline. There's year 4, there's year 5, and what we have is a 0R5 rate, we have a 0R4 rate, and what we really want to get is this one in here, which is a 4F1. So it starts at time 4, runs for a single period. Okay. So why don't you go ahead, if you've got a calculator, calculate it and see what you come up with. Got a calculator? Try this one. See what you can come up with. If you haven't got a calculator, just work it out in your head. Anybody got an answer yet? Yeah? Okay, good, good. That's right. For those of you who are still working, you should come out at around 12.09%. That should be your interest rate. Now, when you do something like this, often it's amazing how many times in exams and stuff I see people making getting unbelievably crazy answers. One way you can actually tell that this thing is approximately right is if you think that that was 7 and that was 8. At this point here, you're 4% behind, and so to get from there to there, what you need is 8% plus another 4. So that means that's 12. And so that means, even though that's a pretty simple way of looking at it, it does tell you that you should get something around 12. And if you're significantly far away from 12, you've probably made a mistake. So in a lot of these things, if you look at the basic structure of it, you can actually see whether your answer makes sense or not. So the fact that you're 4 behind here, that's been 8, another 8 up here, 4, 8's 12, and that if you got 12.09, at least it's a guide that you're probably in the right place. Anyway, how many people got that in the end? Yeah? Okay, good. Okay, any question on that before we move on? Okay. So, when we've been talking about this, we've basically been saying that the long-term rates are just geometric averages of short-term rates. There's a fairly serious problem with that idea. Has anyone, as we've gone through this, seen a problem with that basic idea that we need to address? Just taking short-term rates, averaging them out, getting a long-term rate. Anyone seen a problem with that? Risk will change. Okay, so there's a key point. That's the major problem with this theory is that it takes no account of risk. So we assume when we do these calculations that risk does not matter. Of course, in the real world, it does. And so one we're going to look at in particular is the liquidity risk. So we're going to look at this liquidity premium theory. Okay. So what would be the basic idea of how would we modify this theory, the expectation theory, to take account of the fact that in real life we have a liquidity risk? First of all, what is a liquidity risk? What's a liquidity risk?
Liquidity risk.
Yeah.
I know what liquidity is. It's like how easy you can do something with the money, so liquidity risk. Maybe you can't turn the bonds into money in the future. Not sure.
Well, that's a good guess. Yeah, bang on. Yeah, you're bang on. Basically, a liquidity is be able to turn your investment into cash at fair value, and the risk is that you can't do that. Either one of two things: either you can't sell it quickly enough, so it's a slow process, or the other one, of course, is that you may be able to sell it, but at much lower than fair value. Either way you look at that thing, both of those are liquidity risk. And so, pretty much everything has some sort of liquidity problem. So what's the basic problem that this theory is going to address? Okay, now we know what liquidity risk is. What happens to think about that yield curve, we're looking across time. What happens to liquidity as the time to maturity changes? Yeah, go ahead.
So long-term bonds would be less liquid, and they're more, they have more risk in terms of when interest rates change, their prices change more. So the longer the bond length, your yield will decrease the longer.
Okay, so there's two issues in there about the longer the time to maturity. One is you have more interest rate risk, okay, and the second thing is the longer the time to maturity, everything else being the same, is that they become less and less liquid, and that's simply a fact of life. That when we look at the bonds that are on issue, the longer the term they are, their liquidity goes down. Okay. Also, the other thing you mentioned is that our interest rate risk goes up, and so if we have some sort of systematic change like that, time to maturity goes up, even if all the other aspects involved at the same time, maturity goes up, liquidity goes down, that's a systematic change in risk that we've got to take account of. So there's the 2 points. Bigger interest rate risk. You made that point. Interest rate risk goes up. And they have less marketability, which means they're less liquid. And so because of that systematic change in risk as time to maturity goes up, what we have to do is factor that into our theory of the interest rate. So the basic idea is that when we think about why do we always see that, not always, but why do we all commonly see that curve sloping upward? And you think about what we've said to date, that an upward sloping curve indicates that people think that interest rates will rise in the future. It doesn't make a lot of sense that they think that for most of the time the interest rates will rise, because in practice, they can go up and down. And so the idea is that even if the underlying expectation curve was completely flat, and so that's this blue one along here, even if we did not expect any change at all in the interest rates going forward in time, we still see an upward sloping yield curve because there's this systematic change in risk with time to maturity. And there's two of them. One is they tend to become less liquid, and so it becomes more difficult to sell them if we need to. And the other is they simply have a higher interest rate risk. And because of the systematic change in risk with time to maturity, we poke this liquidity premium on top. You can see it up there. And so even if our expectation is for no change at all in the interest rates over time, we still see this upward sloping curve because of this risk premium. Okay, any questions on that? Okay. So now we'll move to another one. This is the market segmentation theory. So, anyone have any idea what this is? The market segmentation theory is? Okay, so yeah, I think okay. So basically, we're not talking about one market. Okay, we got different pieces. Yeah, different pieces. So this is the idea of this theory here, is that when we look at these interest rates, and there's a wide range of types of bonds. There's government bonds, there's corporate bonds, there's short-term ones, there's medium-term ones, there's long-term ones, there's different investors of different types, that we're not dealing with a single market, that we actually have a range of markets, and all we're doing when we build a yield curve is patch all these markets together. So that's the basic idea. So there may be reasons for people to have, if you're an investor, have a strong preference for certain types of securities, and then the theory is that they only buy those ones that are consistent with their preference. So let's think of why this might be. If you're running an insurance company, let's say you're a life insurance company, what type of investments would you probably hold long term? Why would you hold long-term ones? On your right, go on.
It's likely to be a long time before you get a payout for life insurance policies.
Yeah, life insurance policies are long-term financial commitments. When somebody takes one out, it's probably going to be 50, 60, 70 years before it pays out. But they'll have a whole lot of them. And so because of that long-term financial commitment, they're going to be natural buyers of long-term bonds. What if you're just a general insurance company? Where would you be investing there? You're just a general insurance, cars, short-term. Okay, because you're not making a long-term financial contract if you're providing something with insurance on the car. If the car gets smashed, they pay out. They're not making a long-term financial contract there, not like life insurance. And so they tend to end up in the short end. And so when you look at that, there are definitely investors at particular areas in the types of investments that are available, but also for issuers as well. Okay, so if have a very long-term project coming up that you want to engage in, you probably will go out and issue a security in the long-term area of the market rather than the short-term. And so both from the demand side and the supply side, there are quite distinct markets in there. So the basic idea is that these are different ones, and so they can actually become essentially a little bit disconnected from each other. So here's a bunch of list of types of borrowers that we see. For short-term securities, we'll come to the money markets fairly soon, but this is borrowing basically to overcome liquidity problems. Either you have excess liquidity and you want to invest, or you don't have enough and you want to borrow. And so when you think about who's going to buy them, this thing here, MMF, is a money market mutual fund. So this is a collective investment vehicle. And often, like something like that, will actually have a trust deed which legally specifies what they can invest in. And because it's a money market, they usually will have a specified maximum term to maturity. And so they are actually confined to a particular part of the market by the type of business that they're running. Then we talked about insurance. When we go out into the long term, if you have, say you're Auckland International Airport and you want to go and build a new runway, you're going to buy issue long-term securities because it's going to take you a long time to build that runway. And once it's finally done and you can handle more jets, it's going to take a long time to earn the money back to pay that. And then the buyers, we talked about our life insurance, but also pension funds, natural buyers of long-term securities. So what we see is that we're not dealing with a single market here. We've got different pieces of the market with different suppliers and different investors in each segment. And that can affect the way that the yield curve is built. So there's a basic picture. So the idea is that although that black line there's our yield curve, we actually have pieced together short term here with medium term there and long term there. And so we build out the yield curve essentially by collecting data from a bunch of different markets and put it together. One of the implications is, if you when we saw that funny one yesterday, you can get discontinuities in it because if this market, say for some reason was was up here, was up there rather than there, you'd have a thing that sort of looked like that. And so you can get some discontinuities in the curve with the market segmentation. Okay, any questions on this before we move on? Okay, feedback. Right. So next one is the preferred habitat theory. This is actually a modification of the market segmentation. How does this modify, this one here, preferred habitat, modify the segmentation? Ooh, people don't know. Yeah, go ahead.
So would it be similar to market segmentation in that people have areas they would prefer to buy in, but this theory would account for the fact that if the reward was sufficient, they would trade outside of their preferred area, or essentially adjust what they're investing in?
Yeah, that's basically it. So the segmentation theory basically says that they have these strong preferences and they won't trade outside those preferences, either as issuers or lenders. But we know that's probably a bit unrealistic, because provided that there is enough incentive in terms of extra interest, either if you're an issuer, lower interest, or if you're a lender, higher interest, then people will move in response to incentives. So if the incentive is big enough, then you can move outside where you would prefer to be to essentially get a better deal. So if you're an investor, the better deal is higher interest rates. If you're a borrower, you're going to issue some securities, better deal means lower interest rates. So this relaxes that assumption that it's segmented. And the big deal is they'll trade outside the preferred maturity if they're adequately compensated for additional risk. So let's ask the question, where does that extra risk come from if they trade outside where they're preferred? Let's think of our life insurance company. We know that they would like very much to invest in long term. What's the risk of shortening things up?
So the risk of shortening.
Well, in general. But if life insurance is a good example, they have a preference for these long ones. What's the risk if they shorten up?
If they shorten the securities that they buy.
Yeah.
Yeah, well, they might not get as good a return in terms of that they would get from a long-term security.
Okay, so the yield might go down.
Yeah.
Okay, but what we're saying here is that if there's enough incentive to do that. So let's assume that, let's say the yield curve sloping down out in the long area. So by shortening up, they actually get more interest rate, more interest. Okay, so that's their incentive. More interest back here. They'd like to be out here. More interest back here. What's the risk by moving back? Reinvestment risk, that's definitely one of them, yeah. And what's the other one?
I was going to say, because would it be less risk going that way than going the other way around?
Well, going from short term to long term.
In terms of like, if you're talking about a general insurance company and then buying long-term security, because then you're caught with a huge liquidity risk.
Okay, yeah.
And their stuff.
Yeah. If we can, okay, liquidity risk is quite real, but if we confine ourselves to interest rate risk, and we'll just talk about that for a minute, is if you think back to when in the last section, we talked about this thing that we use to measure the risk, which we call the duration. What a company would like, say a life insurance company, if you look at its policies that it's issued, you can calculate the duration of those policies. And what we would like to do is to match that with a portfolio of assets which has exactly the same duration. Now, if they calculate what the duration is of their liabilities and they see there's an incentive because there's extra interest to be gained and they start shortening things up, then you've got a mismatch between your durations. Okay? And basically what that means is that if you were nicely matched, then as the value of one rose, the other would rise and fall with it if they're very nicely matched. But if you start to move outside your preferred, in this case we're saying shortening up, we get a mismatch between the duration. So this is, in this particular case, by shortening up, the liability is still those long-term ones, but now you're on your asset side, you have much shorter duration. And that exposes you to interest rate risk. So basically, it doesn't matter whether you're going from short to long or long to short. What you have is you get a mismatch between your durations on your asset side versus your liability side. And that's where the extra risk comes from. But again, one of the key things you've got to do in finance is actually price a risk and then work out whether it's actually worth your while doing it. Okay, any question on that before we take any of the other points? Okay. So when we think about what's the consequence for the actual shape of the curve itself, it allows for humps or twists. So like you might get little irregularities there, but you don't get complete discontinuities because if the incentive is high enough, people will move, and that incentive move will smooth this curve out. So if we go out and look at those curves, if we tend to see them smooth, that tends to support this theory. If we can see discontinuities, that would tend to support the segmentation theory. So you might ask this question, we've looked at 4 theories, which is right? As is common in finance, there's not enough evidence to pick one over the other. But this is interesting. I always think this is interesting. Is that the people who actually work in the market, okay? These are people with money in the market, and this is their job. This is, if they don't do well when they get fired, they tend to think that the preferred habitat theory explains what goes on out there. Now, the theoreticians that sit back in their ivory towers prefer the expectation theory. But when we think about them, each of these theories has some value if we have to assess either why interest rates has changed in the manner they do, or we're looking into the future and we're trying to figure out what might happen to the interest rates. So overall, the day-to-day changes, they are consistent with the preferred habitat theory. You do get movement between one segment and the other, but they can be slow. But always, not always, most of the times those yield curves are smooth. You very rarely see a major discontinuity in the yield curve. And if you think about it, a discontinuity represents an incentive either for a lender to move or for a borrower to move maturities. And that will tend to smooth things out. But when we look into the long term, then the expectation of what will happen to these interest rates in the future, and often those expectations are guided by, information, say, from the Reserve Bank and other sources, they do have an effect. So if you are expecting interest rates to rise in the future, what people tend to do in practice, if they think the interest rates will rise in the future, is that do tend to come back into short-term maturities in the hopes that once the interest rates rise, they'll be able to then move back out into the long term. So people will respond to these things. So now we're back to this thing here. This is the second time we've seen it. Now hopefully this makes more sense this time than it did last time. And so the basic idea is that in this direction here, we have a business cycle along there, and this is the peak when the economy is growing strongly. This peak here is the trough when it's either growing very weakly or maybe in recession. And the basic idea is that the short-term rates simply respond much more quickly than the long-term rates. And so, as we said, when you're in the peak, growing faster than the economy can actually sustain, we see this downward sloping curve, and our interpretation is that we're going to slow down, maybe go into recession. This here, the flat one, is a transition. In this particular case, it's transitioning from high growth into low growth, but we could actually have it the other way around, transitioning out of low growth into high growth, and that would be at this point here. And the last one, when you're down in the trough, you tend to see things sloping upwards because the economy has greater capacity to grow. But we can modify that for the existence of these other risk factors. But that's the basic idea of interpreting a yield curve. So any questions on that before we move on further? Okay, everybody's happy. Right. So now we're going to look at several specific risks that you face as an investor and how this affects the interest rates. Because the basic idea is that when you have a risk, is that you have to somehow price that risk. And what we do in that case is, in a statistical sense, we're going to ask ourselves, what's the mean loss we're going to incur by having this risk? And then we convert that into an additional interest rate premium over and above a risk-free rate. So these are the ones we're going to look at. We're going to look at default risk and embedded options. Those are the two we're going to look at. There's two other that are quite important. The tax treatment, although in New Zealand we don't have much variation in tax treatment. Overseas, this can be quite important. And then, of course, the liquidity or the marketability is also quite an important risk to take account of as well. So, question, how are bond investors compensated for default risk? If you have a choice between a government bond, which is pretty secure, and a corporate bond, where you might get a default, how are you going to be compensated for the fact that the corporate bond has got a higher default risk? Yeah, go ahead.
Higher coupon rates.
Higher coupon rates. Or alternatively?
Higher rate of return.
Higher rate of return, which would be the yield. So if you're buying it at time of issue, you want a higher coupon rate. That's what you want. If it's trading in the secondary market, then you want a higher yield. So either case, the basic idea is you want a higher interest rate. And when we figure out how on earth we're going to figure that out, the question is, how are we going to figure out how much extra we're going to want? How are we going to work that out? Okay. How are we going to work out how much?
Just compared to the risk-free bonds, like the government bonds.
Okay, so the government bonds is your risk-free one, so that's your base.
Yeah.
How do you know how much premium to stick on top?
I think that's data from.
Betas is for stocks. But, yeah, I mean, okay. Yeah, we'll come to betas in the equity market section. Okay. So the whole thing is actually statistical. So when you say word probability, there's always, uncertainty around this. Okay. So default risk is that they might not pay you, and the losses can range from pretty small stuff to big stuff. And what you have to do is you somehow have to work out your expected loss or the mean loss for that type of bond. Now, often that's quite hard to do, but ultimately what you can do if you do the calculation somehow is you'll be able to work out what is your actual expected loss in terms of a mean loss, and then you want an extra interest rate that will actually give you that amount back over the life of the bond. So if you say, you're likely to lose 1% over the life of the bond, that's your risk, then you actually want 1 more % over and above risk-free rate. That's the basic idea. Now, we don't do any calculations here about that, but that's basically how it works. So they have this, what we call default risk premium. And as I said, the government bond is considered to be the riskless one, so there's some base there that you work from, and then you add in a risk factor because of the fact that something like a corporate bond has a probability it might default on you. And this is the basic idea. Investors are satisfied if the default risk premium is equal to the expected, and that one there, that's our statistically expected, that's our mean default loss. Now, conceptually, that's quite simple. The problem is, in practice, it's very hard to calculate what your loss is. But that's the basic idea. What you have to do as an investor is calculate what your loss will be on a statistical basis, and then that's what guides you about how much extra interest you want. Now, these things aren't actually, they're not constant. In fact, I've got some data here. Might put it up now. I'll put this up again probably in a minute or two. But this particular set of data here this is U.S. data, and so what we have here is time. This is 2013 up to 2017, and this is the risk premium. This is 0.5%, rising up to 2.5% there on that graph. And this is what we call a BBB corporate bond, and this is the premium that a BBB corporate bond will have over the U.S. government security of the same length. These are 5-year bonds. And so when you're thinking about that risk premium, it does change. It's not constant over time. And basically what we see when we see that is that when we're thinking about what's the probability of default, what something like that tells us is that the probability of default changes with time. Sometimes, that probability of default goes up, sometimes goes down, and the market adjusts the risk premium that is being paid for this type of risk. But we'll come back to either that one or another one fairly soon. But bear in mind, these risk premiums are not constant. So the question is, how are we going to work out this risk? What can we use to guide us about what this default risk is? How would we go about figuring out what is the probability of default? Well, it's very important for us because we've got to price that risk. From the what? From the market authority. So what do you mean by that?
Just third party.
Oh, third party. Yeah. Okay. So in terms of the bond market, there are these. This is group here of three. Moody's is one, Standard & Poor's is another, and Fitch is another. These are things. Well, they're companies. What they do is actually, as a business, they actually rate bonds, and what they rate them for is default risk. And basically, most of the bonds that are issued these days have a rating, and that rating, which will come to exactly what that is, that is the thing that guides investors like me and you who aren't particularly sophisticated about what the default risk is. And when they go and actually assess them, because these companies, Moody's, Standard & Poor's, and Fitch, they'll actually go and visit the company that's issuing the bond. They'll collect data from them that would otherwise be confidential, that's not available to the market. And this is the type of stuff we look at, cash flow, level of debt, basically how much debt do they already have, if they're issuing more, how profitable they are, how variable their earnings are. And then after collecting that data, they eventually go away and will ultimately digest all this stuff and come up with a rating for the bond. And that rating is only about the probability of default. It's not about any other risk that you may face. And once they've issued it, typically they will revise these credit ratings from time to time, although there is a criticism of them that they are very slow to do that revision. But they will sometimes as necessary. Okay, I think the time has run out, so we'll pick it up again about this point tomorrow and finish this off. If you want to ask any questions, be around for a while. Otherwise, we'll see you tomorrow.
They all seem like trick questions. You didn't go over the stuff about over the stuff about the Australian that payment system. Did you go into detail about that payment system? Because I got a few questions about that. I googled it. I just didn't get it Google. So I just put it into it's not that there were bad questions that some lecturers had bad written questions. It's just that it didn't seem to be building on the stuff we learned in the lectures. It just seemed like obscure facts, if that makes sense. Like they're good to test, but what's the purpose of the quiz? Is it to help us learn what we learned in the lectures?